Companies do have the need to raise capital from time to time to fund their operations, to fund expansion, and to capture more market shares. And there are different avenues through which companies could do this. They either come to the market through the formats of initial public offering (IPO), or they may decide to carry out what is called private placements. In this case, it is not done in the public per se. The entire arrangement is done privately. They approach individuals to raise capital without coming through the public public channel. That particular method is called private placements. And so investing in private placements is an important form of investment if you have the opportunity. And in this video, I want to x-ray the benefits and the pitfalls of investing in private placements, the advantages and disadvantages of investing in a typical private placement. Number one is faster capital raising. Private placements are quicker than public. They are quicker than public offerings, due to regulatory requirements. In this case, the requirements as far as regulation is concerned is somewhat few. They encounter fewer regulatory requirements, enabling companies to raise capital with little difficulties compared to a typical IPO. You have to advertise, you publish the brochure, you go through different channels and try to cover and make it as wide as possible. But in the case of private placement, those procedures are not there, and so they tend to do it quietly, and they raise whatever amount of money they need to raise without attracting the attention of the public. Number two is a lower cost. Apart from faster capital raising, there's lower cost as number two. These placements have lower cost as they avoid what is called underwriting fees. There's no underwriting involved. Underwriters don't get involved, and so they avoid underwriting fees. They avoid legal fees, and they equally avoid extensive regulatory filings. That is unusual associated with the typical initial public offering. So they avoid, the fees attached to all these procedures. Not only that, number three is customization of terms. Customizations of terms. Terms such as price, interest rates, and features are negotiable, allowing tailored solutions for both the company and the investors. So number four is confidentiality. This is a very important aspect of private placements, actually. So companies maintain that level of privacy regarding sensitive financial and business data, avoiding the public, when it comes to disclosure, and compared to what is required in public offering. They tend to avoid the public completely, and they are not mandated to disclose so much compared to what is obtainable in the typical initial public offering. And not only that, number five is access to capital. Access to capital. So startups and smaller companies can raise funds without need for IPO, initial public offering, making private placements a useful option, for funding. They just quietly, without much noise and advertisements, with confidentiality, without so much disclosure, They will simply raise money for their operations. Number 6 is exclusivity for investors. Exclusivity for investors. Accredited or so in this case, what is called like in the US and other advanced countries, there's a class of people they call accredited investors. And these people are like high net worth individuals as well as institutional investors, can gain access to exclusive, investment opportunities, potentially benefiting from early stage investment because the entire thing is done in a kind of hush fashion, in a kind of private manner. So, rich investors and institutions have that particular exclusive right to partake in these offerings. It's not really meant for the public. That's a very important feature of private placement. Not only that, number 7 is less regulatory burden, less regulatory burden. Compared to public offerings, private placements face fewer regulatory constraints, making the process smoother and as well as faster. They're not really constrained by regulation compared to a typical IPO. So it makes the overall process very fast. There's no hiccup, bottleneck, procedures here and there to tackle. So the entire procedure is very, very fast, relatively fast. Please subscribe to this channel and like this video. And don't forget to also watch related videos in my channel. I have more than 500 videos designed to really help you as an investor. Please take your time to find time to watch these videos. It will be of tremendous help to you. Number 7 is less regulatory burden. I've considered that. They don't really, tackle regulations here and there. They tend to they're not fully involved in that. So not only that, I want to talk about an aspect that could be considered a drawback, or maybe the pitfalls or the disadvantages of a typical private placement exercise. Number 1 is limited liquidity. Private placements, securities are not publicly traded, making it difficult for investors to sell or exit their investment easily. So they're not available in the stock market. So if you are an investor and you bought your holding in a private placement, it will be difficult for you to exit the markets, exit your investment whenever the need arises. That's a typical disadvantage of this form of capital raising. So the liquidity concern is very, very high. And number 2 is a limited investor pool. Limited investor pool. So in this case, private placements are restricted to accredited investors, reducing the potential capital raised compared to public offerings. So in this case, potential investors are limited. They only consult institutions and very rich private investors to invest. So in this case, they have a limited pool of when it comes to raising capital. The opportunity there is quite limited compared to a typical IPO. Number 2 is higher risk for investors. So you discover that these investments, especially in startups, are riskier as the companies may lack a proven track record of financial stability. So investors have to bear a higher risk because these are new companies, unproven companies without a lengthy track record. So whoever is investing in a private placement is taking a considerable level of risk. So number 4 there is lack of market exposure. So without the public exposure of an IPO, companies raising funds through private placements may not achieve the same level of visibility or investor interest. So because of the lack of advertisements, the lack of publicity, so the entire offering is people are not really aware of what is happening. They're not fully aware of what is taking place because it is done like should I say a hush hush setting or whatsoever. So number 5 is potential for mispricing. Potential for mispricing. So terms are negotiated privately, all right, which may lead to mispricing of the securities or unfavorable times for one party because of the way everything is done. There could be that mispricing. Usually, you may end up buying at a higher price than necessary, because of the way the entire process is carried out. The terms are negotiated privately. It's not done openly. You don't really like to involve underwriters and other firms that are into this particular kind of job to be able to come up with a decent price discovery for the offering. Number 6 is a regulatory risk. Private placements still need to comply with essential security laws. Non-compliance can lead to legal penalties or investor disputes. So they still face regulation. They are still exposed to regulatory risk. They have to comply, or else they will have problems with their investors. Number 7 is smaller, capital raises. Because of the limited investor pool, private placements, may result in smaller capital raise compared to public offering. They can't raise as much as could be obtainable in the public offering, in a typical public offering. Number 8 is potential for over-concentration. That is, we discovered that too few individuals or institutions will end up holding a larger chunk of the company, and it could lead to regulatory problems along the line. It could lead to regulatory, problems in the way the company is run. This is the benefits and of course the drawbacks, the pitfalls involved in private placements. So it is worth considering actually whether to invest as a private investor, or you wait and invest in the company whenever it is floated in the markets. So the choice is yours.